be limited companies. Okay, limited companies. So limited companies means limited liability companies. Okay, limited liability organization. Okay, is a legal entity which has separate entity from its shareholders whose liability is limited. When we talk about liability over debt is limited, it is as if the company, okay, has a shade, okay, of umbrella. There's a protection. Protects them from what? The debts. Meaning, you are the boss. Okay, this is the company. When company is facing some huge debt that they could not pay, those debts only can go until the company. Meaning, you owe people how much? You owe $1 million. Company only have, let's say, 500,000. So the company can only give 500,000. All the shareholders that they invested into the company, and so the company only has 500,000 in total from everybody, their own money and from the shareholders. So only this money can be damaged. So there's a balance 500k to be paid. But this balance 500k, the debtors, the people outside, the creditors, creditors cannot attack the bosses as a personal issue. Yeah, the people outside, the along outside cannot go and attack the bosses. Like if we do sole proprietor, okay, if we owe people 1 million, the company, your own company, have how much you need to pay. After that, the balance 500, you have to fork out yourself. How? You sell your house, sell your whatever property you have, you sell your cars, you sell your motorcycle just to get the 500k to sell to clear the debts that you owe people outside, the creditors. But if for companies such as limited liability companies, the outside creditors can only go and attack the company only. The bosses inside, they cannot attack as a personal. They cannot go after the private assets of the boss. They only can attack the company, but they cannot attack the boss. So that is one good thing about a limited liability company. Okay. So remember, for your this sole proprietor, okay, and this one later on that you'll be learning next month, partnership, they are facing unlimited liability. Anything happens, they have to sell off their own private assets. Then for company, a very big one is a limited ones. How much you have, only how much you give away. How much the people invested in you is only how much you lost. They cannot go after the private asset. Okay, so the financing source, the capital, as in the money, the resources, comes from who? Comes from shares that people purchase from you at a par value. Sometimes they will be having $0.5 dollars per share, or sometimes it's a $1 per share. Okay, members could be unlimited. Anyone can become a shareholder. Okay, public listed normally. Okay, so unlimited members. Liability limited to amount of money invested. How much you invested is how much you lost in case of anything happens. Profit normally you'll be getting in terms of a dividend. Dividend is a side of income, right? That company give away out of the profit they earn for the year. Okay, so how much is your shares that you buy is how much that you will get. There's a certain percentage they'll give. Okay, profit distributed to shareholders. So normally this one, these limited companies, right? We have private limited. Normally this private limited is the so-called the Senjuan Berhad that you see along the streets. When it's a private, then the share is within the people inside the company only. It's not open to the public. But public listed or the public limited company, the PLCs, normally these are the top 5 of the blue chip companies, all the MNCs, HP, Sunway Group, all they are very big organizations. Recently, I heard Touch and Go is already listed. 99 Speedman also starting to be listed in the stock exchange. This one, they has the stock exchange thing. So sometimes you'll be seeing this in the news. Hang Seng, Nasdaq, then Bursa Saham Malaysia. These kind of terms. These are the people, the organization that deals with all the companies, all their shares. That's the stock exchange. That's the share market. Okay, so this is the PLC. Normally, PLC has the shares. It's like the stock of the company go up today or go down today. Is very volatile. How many cents per share? That kind of thinking. Public listed company. Okay, but if Senjuan Berhad, the private limited, is just only within its own self one. Normally, it's like family members or the partners of that particular company only. No other people else. It's not really open. But if it's a PLC, it's open to the entire world. Okay, people from outside world can get to know you and buy your shares and give you money. That's the capital. So if I were to say, public listed company are a kind of a modern street beggars. It's like a modern. It's like asking, I need money, come give me money. I give you shares. You give me money. I give you shares, paper. It's like a modern street beggars. Okay. Yeah, so this limited company. So what's the good thing about having a limited company? Okay, your debts that you owe people is only limited to the amounts that members agree to contribute. So if let's say the members, the shareholders particularly, right, they have contributed 50,000, like all in all. So A give 10k, B give another 10k. So C, D, E, and all the amount total is 50k. Okay, from A, B, C, D, and E, and so all everybody they contribute a an amount of money that altogether reach out 50,000. If let's say there's $100,000 of debt coming to owe to change from the company, right? They only can pay up to 50,000. The rest 50,000, they cannot. The people outside there cannot touch the bosses of the company for their private assets. No, they only can deal with the company as a person. Remember your separate entity concept. Bosses and the company is treated as a different person. Okay, so only limited. So there's a protection. Separate legal entity, only legal actions can take on the company, not the shareholders, the people inside there, the owner inside there cannot. They only take action against the company. So sometimes you see later on when you read the law papers, right? You can say ABC versus Satya Kazana Group. Something like that. The plaintiff versus defendant. There's such things. You can go and Google up about company taken lawsuits against another company. Okay, board of directors run the company, not the shareholders. Okay, the board of directors are the agent of the shareholders. So shareholders is very big. They give money to the BOD. BOD are the one who run the company. Shareholders are somehow the owner. Shareholders will not be there every day. Only sometimes for a meeting, especially those major shareholders, very big fish. Yeah, BOD will be the agency. So there's something called the agency concept. Something that you'll be learning next time under governance in your higher studies. Okay, there's a fiduciary duty by the BOD to run the company in order to provide maximum, what's that called? There's this thing, maximum benefit, some economic benefit for the shareholders. Okay, there's something like enlightened maximum shareholder value, something like that. Something you'll be learning under corporate governance next time. Okay, easy to buy and sell shares in the public listed company. Yeah, of course. You just can buy things and all kinds of applications, or you straight away deal with the bank to buy shares about a certain company and does. Okay. Accessibility to create a pool of capital, because your company is a public listed, so you can ask money for everybody in the entire world. So there's a greater pool of capital. If let's say sole proprietor or partnership, only your own money, you bank loan or from your friend. If you're on the partnership, if you're on your own self money, whatever you have, you use that to do a business. But if a listed company, the entire world is your money. Loans can be obtained easily because you got these shares that you sell to people, borrowings that you borrow here and there. So when you want to get loans, those bankers, they will be easily trusting you. So you can get loans easily. Continuity of existence, yes, you should remember the going concern concept. Company is deemed to be going concern, meaning will be treated as there almost forever, unless there's any intention to significantly reduce the size of the company or wanting to shut down. Then there's no continuity of existence. Even though if the owner already passed away, the company still run, just that who will proceed the heir of the organization is the next of kin or anyone else that they put the trust on. Okay, they're entrusted. So the company still move. However, many legal requirements to follow. Seriously, really a lot. Next time when you learn the law paper for business law, I tell you, you'll be like, oh, yeah. Financial statements must be audited, especially public listed company, because your financial statement will be published in the annual report, and then you put on the website that everybody can download. So your financial statement must be audited. There's not any hanky-panky over there. Okay? But other than that, what also will happen? Okay, let me add on. What also the other disadvantage of having a limited company? Okay, very expensive to form this company. There's a lot of regulations. So yeah, many legal requirements and all the lawyer fees. Okay? And then now, ownership is not solely owned. It's not like a sole proprietor that the entire company is yours. No, now the entire company can be owned by many different people, the shareholders. Yeah. So financing is mainly by share capital. So the capital here, sometimes we just have a general knowledge. Most of the time for this part here, you'll be learning next time in your university. Okay. Issued share capital is the amount that you issue, you give people the shares. Okay. You sell to shareholders. Sometimes also in outstanding. Okay. Normally how they will have this share capital, or sometimes they say stocks, and how they get the money from people. Normally, there's also something called the prospectus. You can go and see any company for those public listed, let's say Sunway Group, you go and find something called the prospectus. Normally, this prospectus, if I'm not mistaken, as what my knowledge I've learned before, is something like an offer. They offer to the public, hey, we are going to do this, do that, and what is our current record so far is this, that. It's like a very thick book also, another like almost nearly 100 pages long. So you read, then they will say, now we are selling you these shares at how much per share, and we need this, and then the expected return will be how much. It's like a selling point. A selling point give you some hopes, and then in return asking money from you and giving you paper in return. So they will use this prospectus to ask people to invest in your company. So when they invest, right, there's amount issues or sell normally in outstanding. You just buy first, you just book your spot. Then there's this thing called the call-up capital. So they already issue, right? After that, hey, remember to pay, hey, remember to pay, remember to pay. You owe us money, remember to pay. We already give you the shares, now pay us. So this is the amount requested to pay. Then paid-up capital is the amount, the actual call-up capital that is received from the shareholders. You issue 100, okay? So maybe 20 is already paid, but the 80 people haven't paid yet, belum yet. So they call you to pay, being called to. So now, after that, all 80 people, all the shareholders already paid in full. So everything settled. You already get all the money inside your pocket already. Money already inside here. Okay, there's actually another thing called the allowable share capital. It's like every company, they have this kind of wallet. How much is this wallet can fill up in, let's say, 1 million? This is only your allowable share capital that you can ask people to give you. Then the amount that you get ready is the amount that you can fill up already lah. So let's say here is there's 100K out of the 1 million. So you still have another $900,000 of space for people to invest in you. And definitely, if you want to increase your allowable share capital, then you have to do all kinds of legal processes again lah. Okay, so this is a touch and go about capital share, issue share capital, call up capital, and paid up capital. Okay, very rare. Maybe sometimes they ask a little bit of a calculation, but normally I don't see any questions about this kind lah, unless it's self-made one. Okay, so just touch and go. You can Google and see even more. I'm sure there's a lot, even much more names that you will see. Okay, I also will try to go and find out more questions about this issue cap, share capital, call up capital, paid up capital, maybe some of the calculations. Okay, but here, because I'm much more on the on the exam-oriented base, so normally the question that you will see here is the ones normally you can see in the exams lah. Okay, and this chapter is quite just good enough. It's just nice. It's not that hard because the question they ask, right, is like almost the same. It's like repetitive. You see a flow. Oh, like that. Oh, okay. More or less the same each time. Okay. Now here some shares here. Okay. So the types of shares that companies sell to the outside world to get money from. Actually, this thing is called as financial instruments. Next time in your further studies let's say if you go for ECCA or something similar, okay, for professional courses, you'll be seeing this thing called the financial instruments. It can be financial asset, can be financial liability. Okay, there's an asset and liability though. Okay, under the IAS number 32, 39, IFRS 7 and IFRS 9, if I'm not mistaken. Okay, these are accounting standards and the international financial reporting standards. You can go and Google search this part. There's like a lot. I remember studying this until I'm like, oh, okay, understand already. But after that now, I'll give back to my lecturers. Okay, so shares here, we normally will have the money that they get right from people can be in two ways, One is through debts, one is through equity. If we talk about debts, that means liability, And equity is our capital in the form of like the capital portion. Okay, the owner's capital. Okay, owner's equity, capital form. So we have two types of shares here. One, we have the ordinary shares. Okay, they call it the equity shares. And then another one more, we call the preference shares. So normally these preference shares, I call them as the VIP. Because why? The dividend rate is fixed. When you invest 1 million, let's say, that 1 million will represent $1 for 1 million shares each. So out of these 1 million shares, if let's say you're under the preference share, let's say that share is 8% preference share. So every year, you definitely get 80,000, 1 million. Every year, for sure, for 100% sure, you get 80,000 fixed. Okay, let's say you have 1 million shares that you purchase. Okay, so meaning it's a 1 million unit of shares each at $1. Okay, if this is you are the investor, you invest in the company for 1 million, so you got 1 million unit. And if that share is, let's say, 8%, okay, the dividend rate every year that you get is 80,000 for sure, without fail. So you are prioritized because you're VIP, preference shares in general. Okay, if let's say you're the ordinary shares, you have this much of shares that you invest in the company, you have this 1 million unit in your hands, your dividend rate is unfixed. Meaning, suka-suka, the company, if let's say based on this year's performance or very good, maybe in year one, the dividend rate the company declared is 10%. So you get how much? 100,000. But if let's say in year two, the company is not doing well, so they only declare 6%. So you lose lah, right? But if let's say during the year two, they declare 6%, right? But if you're a preference shareholder, you get 8% for sure. You won't get the 6%. But then if year one, like just now you saw it's 10%, right? Well, preference shares owners only will still get up to maximum 8%. They will not get 10%. So if you talk about risk-wise, ordinary shareholders, the dividend that we get changes every year. So I would say the risk is very volatile or high or like medium high. But if for preference shares, the risk is like low, very low. So for me, I would choose preference shares first as a start. And once things is okay for me, then I'll go for ordinary shares for fun. Yeah. Okay. You understand, guys? Any questions? No. Okay, now next. Now because preference share is like VIP, they enjoy a lot of things. So votings, right? They cannot do vote preference because VIP, there are too much of things they enjoy already. So they cannot vote at all. But ordinary shareholder, they can vote because they are quite kesian lah. Or they are quite pitiful because the dividend unfixed, their secondary priority. Then, like you see here, in place of closing down the company will pay whatever is left for preference share first, then only shareholders of the ordinary ones. So ordinary shareholders is always treated last. So here is very sad, very sad. This one's very sad. So at least voting rights, I give you happy a bit lah. But if you're preference shareholders, you're VIP, you're happy here, you are being prioritized, and then you get paid first. But then only thing because you're too much happy already, we give you something to be set first lah. Only one. That's why the risk is very low for preference. But for shareholder of the ordinary ones, they're very high. Okay. Now, these preference shares also got two things, One is redeemable, one is non-redeemable. And what the heck is that? Okay, redeemable means you see, company want money. I change color. Company, they want money. Money. Please, money. So outside got a lot of people, right? All these shareholders. So we say, okay, I want money from you. I give you something called shares, yeah? Okay, I give you shares. And then people outside there give the company money, and therefore company happy. Yeah. So now this redeemable is what kind of redeemable preference shares? This one, you see, the dividend is treated as a finance cost, and it's a non-current liability at SOFP. So meaning to say, this redeemable preference share is a kind of a debt. So it's like this, Hey, I need money from you all. So I give you share first, then you give me money. Then because you're under redeemable, right? So once I'm okay already, I will pay you back the money of that redeemable preference shares. So that's called redeemable. The meaning the company will pay these shareholders to buy back that particular redeemable shares of the preference funds. So it's like technically speaking, it's like you're taking a loan from people. In a promise later on, I'll pay you back. In a way, I redeem back that shares that I given to you before. So this one, that's why they call it a non-current liability at the SOFP. And if you give dividend, it's considered as a finance cost. It's like interest. It's like a loan interest. Then for non-redeemable, or they sometimes call it as irredeemable, which is a matter of English, is I want money, I give you shares, then you give me money then this one you don't pay back. You see, it will become dividend is paid as a form of deduction in the SOCIE. SOCIE stands for Statement of Changes in Equity. Meaning your SOFP there, right? Still remember we have the owner's equity, the capital portion. This side here has many things. All these calculations, the total that you see here, has a different kind of a workings, which is shown in the SOCIE, which we'll deal with it like later, or possibly next week already. Okay? So the dividend is minus from the SOCIE, and it's included in equity and the reserve section. Okay, we'll see later. So when it's equity, means they won't buy back the shares from people. Instead, they own it like forever. Unless the shareholders say, I don't want to invest in your company, I want to divest. They say divest, means take out the money from the company and go transfer elsewhere, invest elsewhere. Okay, so equity is like forever is there. But that, you get the money for a meantime. After that, you need to buy back the shares from people. Because the people is like you owe the people, the shareholders there. So this is redeemable and non-redeemable. Okay, now there's another kind of a money instruments that company get from the world outside there called debentures, which is kind of a loan notes. Again, because it's a loan note, so there's a percentage. Okay, there's a percentage there. And it is again non-current liability. Therefore, you have to pay finance costs. It's like interest. And in case of anything happen, okay, and normal timings, debenture holders are paid first. These debenture holders is like even much more VVIP compared to the VIP here of the preference shares. This one I can call them like a VVIP, even higher than a preference shareholders. So next time when you have money, which one you want to invest in? Which one you want to invest in the company and earn from the interest? I can suggest you debenture. Okay, definitely a lot of things out there. There's really a lot more kinds of financial instruments that the company want to offer to the public. There's a lot. There's another kind thing called the bonds. There's one thing called the options. There's also another thing called the swaps, convertible bond. Like many things to learn. You can learn first, but when you have the money, this is a little bit of a money knowledge. You have, let's say, you earn 10,000 a month. For investments, you just put a 10% to do your investments here and there, 1K. Don't go more than that. Okay, you do not want to get addicted to. Okay, just 10%. So there's this thing called the 6 jars money saving skills by T. Harvey Eker, who wrote the book Secrets of the Millionaire, something like that. There's this 6 jars concept. So 10% only you spend for investment, okay, 5% for giving, okay, like donation lah, okay, then 50% for your life necessities, okay, then another 10% for education, another 10% for long-term savings for, let's say you want to do for your financial, another one more 10%, okay, let's see, okay, let's see, so it's at 5, 6, 7, 8, 85, okay, what's that? There's another one more thing called the let me go and Google search for that. Last time I used to do this, but then as life comes in, I have to change my strategies. 6 jars, financial management system. Okay, let me see. There's a 6 of 5. Okay, your necessities is 5%, 55. 55% is for your necessity. Okay, 10% for education, 10% for long-term saving. Let's say you want to buy a Nike shoes that is costing like what? Almost 1,000 there. So you save. Okay, there's also another 10% is for playing. You want to go travel, you want to buy movies, go for movies, for entertainment. Okay, this investment could be also called as financial freedom account. Yep, this one, 55, 60, 70, 80, 90, 100. So some, money management kind of knowledge to learn. Okay, this one school will not teach you. Okay, this one is you learn from those business people. Sometimes there's this event called the Millionaire Mind Intensive program done in some hotels here and there. You can go and find out all these things. Okay, so they will talk about some little bit of investment here and there, and of course they will upsell you some other courses that they are selling in the during the training. Okay, so always remember, if let's say when there's a closing down, shares, these preference shares and the ordinary shares will be paid only after settling of the liability. Okay, so this is the one. So any kinds of liabilities will be paid first upon winding up. All whatever kind of liabilities they have, secured ones, of course involving debenture holders, will be paid off fully first. Then followed by preference shareholders. Then only lastly is the ordinary share capital shareholders upon winding. Okay. Any questions? Now 8:18. So got time to finish off the theory part. Any questions, Hamza? Hihi? No question. Okay. Hihi? Hamza? How are you doing there? Yeah, okay. Okay. So definitely this topic, this shares thingy is a lifelong knowledge. And yeah, one thing, don't get scammed. Because there's a lot of platform out there. You don't know which one is which. Not to mention Bitcoin, cryptocurrency, all this kind of blockchain thingy is like, it's viraling here and there outside there. And really, we only can pray that we get the right people to guide us when the time comes. Okay? Other than that, the things about wealth that people won't teach you is about network marketing, property management, insurance as a becoming agent, becoming a salesperson. These kind of skills, school will not teach. Yeah, unless you go to colleges that are really very hands-on. Find for colleges, if let's say you're into business, you can find on the college that are very, very hands-on. There's one college that I know that starts with the letter P. You can go find yourself later on, you can be any person. They are very, very hands-on for that particular college. If you are into business, they are really like very gung-ho style. It's like a reality show. Of course, with all kinds of assignment, they are very, very hands-on. Okay, come. So there's this called the financial statements of limited company. Okay, one thing to know is that the format is the same as that of a sole trader. Only one difference is that if they mention to you director remuneration, okay, it's an expenses. Okay, director's remuneration is expenses. Finance costs will include debenture interest and dividends on redeemable preference shares, other than your loan interest, as usual that you know for your sole proprietor. Do you remember that you're doing all the adjustments for your sole proprietor? Do you remember? Sales minus cost of revenue minus sales return, then minusing off the cost of sales, and then what else? Add other income minus expenses, then you get profit from operations. And after that, you minus something called the finance cost, the loan interest, only loan interest for your level. Then you get profit for the year. Do you remember that? Still just that your finance cost that side, the loan interest. Other than that, you're also paying debenture interest and also the redeemable preference shares. Because why? Why you pay the finance cost? They are all debts. Okay. And for all limited liability company, they need to show something called the statement of changes in equity. Okay, this summarizes the changes during the year for the share capital, non-redeemable share capital, the preference share, retained earnings, and general reserve. Normally these four. So you see the SOFP of a limited company, on the equity part, you'll be able to see these few things, as well as the preference shares, if there's any here, preference share capital. And the amount that they have over here, okay, that you see in here, right, comes from this. This is the workings. Balance at the start of the year, of course, like 1st of January, everything was the balance brought down. Then you issue the share, okay, so meaning you get another money. Profit for the year will be called the retained earnings. Okay, then dividend paid out of retained earnings is the final dividend from previous year. If let's say starting of the year is 1st January 2025, dividend will be paid here. First of them is the final dividend of previous year for 31st December 2024. And then dividend paid during this year is the interim, because dividend they will pay normally 2 times. Okay, normally for preference shares. Okay, got 2 times. And then ordinary share capital also, they can also pay 2 times. Really depends. They want to pay one shot for the entire year, or they want to cut into 2. That's really dependent. Transfer to general reserve. Okay, you normally is minus off the retained earnings and you put inside the general reserves. So you see some certain terms here, like what is that? Ordinary share capital. Okay, we might be understand already. But what's general reserve and retained earnings? Basically, the profit for the year is inside the retained earnings. And what is that? Okay, next time when you are in university level, when you are dealing with ACCA or ICW, normally everything, whatever kind of expenses or income will be dealing with the retained earnings. It's like your profit for the year has its own account. It's like called the profit for the year. There's a call of what? It's something like a profit account, but we don't call it profit account. Instead of profit account, we call it as retained earnings account, RE, in which the balance is a credit balance if it is a positive. If it's a negative balance, means it's a loss. So what is this? You see, okay, any profit not distributed as dividends are carried forward to next year as retained earning. It's like the earning that you keep in you. And to be honest, this retained earning, sometimes the money is not fully cash. It's like because you have other income, like what reduction in your receivable allowances, in your provision of doubtful debts, and what else? There's this depreciation, provisional depreciation. So your retained earnings has a combination of this non-cash stuff in it. So retained earnings may not be fully as cash, but when they distribute dividend, it must be in cash. Then there's another thing called the general reserve. It's like of the retained earnings, you split out another part of it, you split into 2 as 2 different parts. One is the active one, the retained earnings is active because you're paying dividends out of it. Then this general reserve is like, it's like a fixed, it's not a fixed deposit, it's like another bank that you created to put there as a reserve. Reserve means what? Reservation. You reserve like as a savings, another separate savings that you just let it accumulate. You're not going to touch it that much unless you really need to touch it. It's like the money that you have in total, you go split into few. Something like you split that into different jars over here. Something like that. Imagine this is the retained earnings, all the profit that you earn. You minus dividend out of it every year. But you split another amount into a different jar as a general reserve. So that is they call the general reserve. So it's a specific percentage of money set aside from the profit. It's used to fulfill future contingencies, meaning future like sudden emergency or whatever you want to do. Okay, paying dividends to their shareholders if they need it. Like let's say not enough money, but there's another side of the part that they created got money, or you want to offset future losses. So to make yourself positive, something like that. It's a general reserve You reserve somewhere outside that you're not going to really touch. You just let it accumulate. Something like that. It's like a different separate savings account. So this chapter is quite nice. Okay, any questions? Now this is the part. Just let you all know. In college, for limited companies, there's a lot of things to be learning. Bonus, convertible, group accounts. This one is the main one. This one is the main headache for every student who pursuing accounting. You definitely must face group accounts because there's a lot of subsidiaries. So you want to go and produce an income statement, everything. You need to combine. How to combine? You learn more. And then this is financing and capital part will be both in financial management and also financial accounting. Okay, in your future syllabuses in university. So it's quite fun to learn though. Do as much as you can to enjoy your learning.